It's a great pleasure to be here today. I must adjust this very carefully to my size. All right, I hope this is quite legible. What I would like to discuss, and I'm stepping back as I was asked to do, from the covered bonds in a narrow sense, to look more at the housing market and housing finance systems globally, and also the need for housing globally, so that we can place the need for the expansion of covered bonds in the context of the overall need for housing and for longer-term funding of that housing across the world. So what I wanted to discuss today briefly, all very briefly, because we only have a short time, is to give a bird's eye view, I call it, of global developments in housing finance. What has been happening there? And what are the growth opportunities, and where are the growth opportunities for investment in residential? And they are mostly in emerging markets, because they will be by far growing much faster than advanced economies. I want to briefly give an overview of the funding sources that are at the moment available in emerging markets, particularly. And then I dare to dip my toe a little in the covered bond development market and what I see as the constraints, and building particularly on what Richard, but also other speakers have already mentioned as the constraints in emerging markets to expand the covered bond options. And that's very important because you have to have a long-term view. As we mentioned during these different sessions already, it takes a while to develop the framework for covered bonds. But they are going to be very important in global markets. So let me first start with the bird's eye view of what we see happening in the housing finance markets. So we have seen very low rates for a long time, and I have the slide, to show that very long time, low rates of mortgages, interest rate in the mortgage sector. We also have seen an increase in the fixed rate mortgages, or part fixed rate for 2 years, and then going variable. These hybrid instruments have become much more important. And that is, of course, related to the need and the demand by the consumer. They love fixed rate mortgages as much as the system can deliver them. But we have also seen an increase in household debt, and particularly, not everywhere, but particularly in emerging markets, that's a constraint for the development of the mortgage market. And these figures are very pronounced really globally. Then we have seen also, the second point, regulatory restrictions. So a much closer look by the regulator on the LTV, the DTI, since the global financial crisis, of course. And that has impacted demand and affordability, which combined with the demand for, or the need for, climate-friendly housing, which makes the housing product more expensive, has really impacted affordability in many countries. And it is very difficult to see how you can expand the housing finance system and the housing market without subsidies in many countries. And I come back to that subsidy part later on. And Richard already mentioned it. So we need them, but we need them in the right way so that they don't impact the development of markets. Very important. So then more recently, we have seen an increase, of course, because of inflation, in the policy rates in most countries, and related in the mortgage rates. And that, again, has reduced the supply of housing. It has impacted supply as well as the demand and the number of transactions, and so on and so forth. So all those things, the recent issues, we all know what the problems are with that when house prices rise, interest rate rise, so that affordability is really impacted severely. And this in emerging markets where we already have an affordability issue that is so much worse than in advanced economies, this is really a killer to the market. It has been very difficult to keep going in many of the markets. So here are just a few slides to show that the trend in the mortgage in the nominal rates in advanced economies and in emerging markets. So advanced is, of course, red. And then the nominal house price, how that house price has increased rather severely in the long term. And it is not, as you can see from the two slides together, it's not only related to the interest rate. It is related very, very much to supply-side inelasticities. So we have seen that in many countries, the house price, and I like this BIS, this is from the Bank of International Settlements, how they have plotted this next to each other. We can see that where the supply of housing is inelastic, the house prices have proportionately increased much more. And we see that within markets as well. Within a large market like the United States, if you take San Francisco compared to Philadelphia, my hometown, it's incomparable what the prices of housing have done. So I have one of my children in San Francisco, one in Washington, D.C., and we are in simple, very elastic housing market of Philadelphia, compared to my children that can absolutely not afford to buy a house in either Washington or San Francisco. And that is purely related. I mean, the housing, the interest rates in the mortgage markets are the same. The movements are the same. It's just the supply elasticity that is very, very differently. So in here you can see the trend in in the fixed rate, the decrease of the fixed rate mortgage, the increase in the fixed rate mortgage, sorry about that, relative to the variable rate and the hybrid rates. So we see at the same time a trend towards more fixed rate mortgages, and that's important when we talk about the funding base of mortgages across the globe. You can only fund fixed rate mortgages when you have access to longer term funds. So this slide summarizes basically what we have seen, all the different trends and movements in the housing and housing finance market since the global financial crisis. We had that crisis, we took care of it, we had stricter regulations, then COVID hit, then inflation came in. This has been a very difficult ride for the housing markets and for the housing finance systems. And that has hit emerging markets particularly. So you can see how different the picture is in the real house prices in the short and in the longer term. It is a mess. There is not one trend. And that has a lot to do with the real side of the market as well. And the real side is also very influenced by finance. So in short, that is the bird's eye view of what has been happening in the last decade, particularly globally. Then I want to talk a little bit about the investment needs in the residential sector, and particularly the emerging markets. We know the stable need for housing in the advanced economies, but where the need for housing is enormous is in the rapidly growing, not Latin America, but the rapidly growing part of the world. I call it infinite. When I do the calculations on the housing units needed to house the growth in the population, it is nearly infinite in emerging markets. And you can see it very quickly on those slides. Look at Africa and Asia. The population, this is the population pyramid. The broader the base, the more the younger the population and the higher the household formation in a couple of years' time, and therefore the need for housing. You can see that Europe is having a shrinking base, so far lower need for housing because the population, the household formation will be very small. Latin America the same, it is tapering off. So the enormous need for housing that Latin America saw during their period of urbanization is basically gone. So very different across the different continents. And when I specify it more, I can see that particularly sub-Saharan Africa, as well as India, and Indonesia to a slightly lesser degree, but are countries where we have the working population, which is the population that requires new housing, is growing exponentially. So we can't ignore what is happening in emerging markets, and particularly not in sub-Saharan Africa and India. When we now look and add to the population growth, the growth in urban areas because of the movement from rural to urban, we see that that picture escalates dramatically. This is now 2020. When we now look at the red dots, the large cities, the countries where we have 75% of the population in urban, compared to now, we see how incredibly strong that urbanization is going to affect emerging markets particularly. So there is no escaping it. It's good. Urbanization is good. We shouldn't try to keep people in rural areas because the GDP growth and the GDP in urban areas is much stronger and larger than in rural areas. So it's, on the whole, excellent that we are urbanizing. It's just we have to prepare for it, and we have to know what we can do to house all these people and not have them first live for 20 years in slum or squatter areas without sanitation before they finally may be able to acquire a house. When we look at the economic picture in emerging markets, it's very clear that emerging markets are the engines of global economic growth. The difference in global output and GDP growth is striking. You can see it in the figures. 2.4 globally expected for 2024, and emerging markets 4%. But there are major differences across emerging markets. But on the whole, there is enormous growth in emerging markets that really stimulates global growth. When I now look very briefly, and others have already mentioned it, at the investment potential of emerging markets, we can see that the risk-adjusted return on sovereign debt is performing very, very well. So I know everyone is a bit pissed off by the low sovereign ratings, but that's different because the sovereign ratings form, of course, a cap for covered bond and other issues. I'm not talking about that. I'm talking about the annualized returns in emerging markets relative to advanced economies. And you can see that the performance over the last couple of years, the last decades, are rather good for emerging markets. So that investors should also not be too worried to come into that market. This is more of the same. I will leave that for later. So what are the current funding funding systems, particularly in emerging markets? Of course, deposits are the basis everywhere, also in advanced economies. Then we have other corporate liabilities, and the corporate bond markets are growing in emerging markets, but it is only going so far to fund your mortgage portfolio with corporate bonds. It depends very much on your rating, of course, whether that is a viable option. Then, for that reason, that we do not have long-term funding available in most emerging markets, we see a growing trend in liquidity facilities that are supposedly better able to access funding from the capital markets at a better rate, although that is not always the case. Many liquidity facilities suffer from lack of government support, and therefore their rating in the market is not much better than individual financial institutions' rating, and they are not really developing in the way that we need them to develop. Then we have covered bonds and securitization, and they are both growing, but very, very slowly, far too slow, according to me. Then we have a whole different category in emerging markets, particularly, and that is state funding, provident fund funding, all these subsidized entities that have been put in place in earlier periods of high inflation in the 70s mostly, and that are now being established again because of high inflation and lack of affordability. So we see a lot of state funding systems, nearly all fixed rate at very subsidized interest rates. That makes the pool of mortgages from these state systems nearly uninvestable. You cannot expect a covered bond or a securitization using 6% cash flows from 6% mortgages in a 15% market rate environment. You can simply not over-collateralize that differential away. It's no way. So in all the countries where we have a dominance of state-funded systems, we are running into trouble accessing capital markets. So, but we see a lot of progressive developments when the scale of mortgage lending is growing in emerging markets. I think, yeah, I will skip, I think, over this. I have just already explained this. At Hoek-Smit, that data website, we provide information on what the prime, secondary, third sources of funding are for the mortgage sector. And we see in most countries that the primary source of funding is still retail, with all the limitations that retail funding have, of course. But we also see, this is Latin America, that we have a large role by these provident funds, and that in many countries, these are the primary sources of funding, and that is all heavily subsidized. And that's a problem for the expansion of access to the capital markets. this is just a slide showing that capital markets have not grown with GDP as much as they should. What we should have seen in emerging markets is that capital markets grow relative to GDP, so faster than the GDP of the country, and we don't see that. So that is a problem when we talk about funding from the capital markets, in emerging markets, where this is absolutely needed. So lastly, and very quickly, my take at the challenges that we face in expansion of both covered bonds and securitization, but particularly covered bonds for this audience, of course, in emerging markets. What are the main challenges that we have to work towards to get this market to open up? And we need it. You saw the numbers. So I'm so impressed with all the work that has been done on the harmonization, the background of all these mortgages, all these covered bond systems, internationally and beyond the European covered bonds. So a lot of it is known, and a lot of it is easy to implement. The dual recourse, the over-collateralization, the bankruptcy remoteness, the asset segregation, all of that is not an issue when we go to emerging markets. It has to just be codified, but it can be done, and it is widely understood. What is a problem is the eligibility of the covered assets. We do not have the same quality of the covered assets. We also do not have the same type of institution with supervision that is required for the covered bonds. And then, of course, dealing with that predominance of subsidized mortgages in several of the market. And then, of course, the legal financial governance, green bond regimes, and so on. That is still, I will not touch that here. So asset eligibility, what is the problem? We have nearly 70 to 90% of the population, the working population, work in the informal sector. How do we grow our mortgage market while we include that enormous part of our working population? India has done a tremendous job, and it should be our example on how to expand access to mortgages with the approval, or I should say, the lack of penalty imposed by the central bank on going to a more risky client. And they have done that together with the central banks very, very well. So they have developed systems to underwrite informally employed. So that is something that countries have to begin to address. Far too many or too large a proportion of the working population is working in the informal sector. So how to do that? And then, of course, improving of your property registration systems and the reliability of that system so that you are not plagued by lawsuit when you have a default, stuff like that. And then the same, you have to begin to think about the type of assets that are being, that can be securitized or can be part of a covered pool. Can loans to retrofit or improve homes, can they actually be part of a covered pool in these countries? How can we make that more attractive for investors and so on? So we have to work hard, both on the asset side and on the borrower side, to make the pool of qualified assets and borrowers larger. in emerging markets. And then the other part of the problem is the quality and the supervision of the issuing financial institutions. In many countries, cooperatives, building societies are much larger issuers for mortgages than the banking system. But the banking system is nicely supervised by the central banks, but these other institutions are often not very well supervised or by not very trusted supervisors. Provident funds are not supervised very well in most countries. They are just outside the supervisory framework, but they make 70% of the mortgages. So microfinance NGOs, how are they supervised if they make a lot of mortgages? That is an issue in emerging markets. So that's another. And then I have already talked about the challenge when most of your mortgages are subsidized, and your cash flow is therefore a subsidized cash flow that you cannot sufficiently over-collateralize to make it investable. So that's a major issue, and I have given different examples of countries, and I can talk about them later on if you're interested, of countries that have begun to address this way of subsidization. You want to subsidize without really jeopardizing the market interest rate of your mortgages. So subsidize in any other way, but do not touch that cash flow, because you cannot access capital markets if you do. So in Wharton in Mexico, that is the Provident Fund, has done a fantastic job in changing that, because they couldn't expand, they could not sell, they could not get a loan against the pool of subsidized mortgages that they were sitting on. India's subsidy program, they have initiated a couple of years ago, and they did it by way of a buy-down, so that the market rate was charged by the issuer, but the subsidy brought down the interest payments of the customer. But the mortgages are made at market rate. That is the right way to do it, but many countries and provident funds don't do that. Korea separated completely the mortgages that were subsidized. They are now in a separate fund from the mortgages that are non-subsidized. That is the way to go. Concluding then, I know we are very pressed for time, but we have had a very volatile period in housing supply and in housing prices relative to incomes of the population. So affordability globally is much worse than 1 decade even ago. The worst effects are in emerging markets, but there are lots of growth opportunities in emerging markets because of the pressure of demand, as long as we find ways to open up these markets. But they need access to capital markets at affordable rates. So, and that is the challenge. How can we blend the funds, or how can we access capital markets in a way that it is actually not increasing the cost of our mortgages relative to when you fund your portfolio purely on the basis of deposits? That is the tension and the challenge that we face in emerging markets. Covered bonds are an effective option when we get all the legislation put in place, but there are constraints, and I just mentioned those. So that is all I want to say.